Paytm's crash following its listing on the stock market has not just hurt the company and the market, but has also clouded the prospects of startups that were looking to launch their own IPOs. Paytm's oversubscribed $2.44 billion IPO last week made it India's largest ever. However, shares of the Indian digital payments firm disappointed in its trading debut after the company's stock sank 27% below its issue price on the BSE and NSE. On Monday, its shares opened with a downside gap of 51.8 rupees per share, only to lose 17% from its listing date close of 1,560 rupees 80 paise on NSE. On Monday, the Paytm share price stood at 1,286.60 rupees on the NSE, which is 40% less from its upper price band of 2,150 rupees per equity share. Even though the shares recovered by 6.5% on Tuesday, it wasn't enough to make up for the losses. So, what led to the crash of Paytm and what are its results?
What we are seeing in markets past, say 1.5-2 years is one straight rally. Okay, it was a fierce bull run, and during bull run, such things happen. What happens is a lot of IPOs keep coming, which we are already seeing right now, and every IPO, every company tries to raise as much as money possible. So nothing wrong on their part, but as an investor, we got to be careful. Overall, this is a lesson learned for investors that you should not be blindly investing into IPOs just because it is a new company or famous company. Valuations are the most important thing while investing.
India's equity markets have been on a roll this year until Paytm's debacle. This was fueled by the RBI's move to slash interest rates to a record low. The COVID-19 pandemic also led to a huge technology adoption in the country, which helped the valuations of many technology companies soar. Firms in India have raised about $15 billion through IPO this year. This is already an annual record in terms of total proceeds. The rally encouraged at least half a dozen technology startups to seek public listings. Yet, experts have been questioning valuations on some of these IPOs, given that they are still loss-making companies. The Paytm debacle has dimmed the mood in India's stock market, with its benchmark S&P BSE Sensex index dropping 4 sessions in a row, which is the longest losing streak in a month. While the market sentiment has taken a hit, it has proved to be an eye-opener and set the market on a course correction.
Market sentiment overall has actually, I should say, got punctured a bit, and now what will happen is investors will suddenly start looking at valuations also when fresh IPOs start coming. Now on, the companies will try that they should leave some space for the retail investors and the investors also to make money and not raise money more than what actually it should be. Future is not bleak, definitely. Future is good for companies. It is not going to impact negatively for the future IPOs.
Paytm's plunge has also cast a shadow over the prospects of other startup firms preparing to go public. The Economic Times reported today that payment services firm MobiKwik may delay its IPO by a few months due to lack of demand from investors and a 30% to 40% drop in valuation. Oyo Hotels and Homes and logistics provider Delivery Private are also likely to keep their IPO plans on hold for now.
MobiKwik is also similar story, no? Paytm is a bigger company, and MobiKwik is a bit smaller company. That's the only difference. But had Paytm been successfully listed, in the sense had it shown premium and gone up after the listing, MobiKwik could have come at similar valuations. Now it is a warning signal. The only key takeaway for everybody is that don't try to rob the investors. This is a harsh word which I am using. Don't try to rob the investors. Leave some space for them also to make money, and investors will actually reward you.
While the Paytm debacle may have dimmed the mood in India, it has also provided a much needed and timely course correction as the market picks up. A Federal Report.